This is your LMAX Exchange technical update for Thursday, August 10th, 2017. Eurodollar. So despite the gains that we saw in the recovery in the market in Wednesday trade, the euro was still in the process of correcting off that 2017 high just over 119, and there is still risk for additional declines in this market before it considers a resumption of gains. We could of course see the market push back up and break above the 2017 high at 119.11 and towards 120, but considering where those weekly technical studies are highly extended, we should still see a more significant downside extension before the market considers a resumption of this uptrend that we're seeing in 2017. We've highlighted the 50-day moving average as a reasonable level for a pullback, which is in the 114s, before the market considers that next big push. So even if the market does reverse higher from here and takes out 1911, trades up towards 120, the risk here, the greater risk, is that these technical studies that are highly extended on the weekly chart unwind a little bit more, and there's that greater risk to the downside, potentially back towards the 114 area where that 50-day moving average is, before we see any significant continuation of gains in this uptrend. Sterling dollar. So cable has pulled back below 130 in recent trade after trading up to a 2017 high above 132. This market could see additional choppy consolidation before it considers a continuation of gains towards a measured move extension, which is at 135. Overall, we are seeing a significant structural shift in this market in 2017 following the pushback above some resistance that had been capping gains at 127.75 earlier this year, but setbacks that we do see should be very well supported now towards that previous resistance now turned support. Again, it could still take some time before the market considers that next big push towards 135, and in the interim, some more consolidation, but being supported down in the 127s. Ultimately, only back below 125.90 would compromise this outlook. Dollar yen. So dollar yen remains pressure to the downside as the market continues to consider the possibility of a retest of the 2017 low just ahead of 108, and any rallies that we do see should continue to be very well capped. Ultimately, it would take a break all the way back above 114.50 to suggest that this market is looking to consider a different plan and maybe a resumption of what could be a longer term uptrend. But for now, the pressure remains on the downside, and the market is expected to be well capped into rallies for a retest of that 2017 low. Euro Swiss. So as we had warned, Euro Swiss had traded up to significant overbought readings as the market surged through 112 and all the way up above 115. And so we've seen the onset of this correction in this market back down into the 112s thus far. We could still see this extend some more to that previous resistance at 112, that previous breakout now turns support before the market considers a formal higher low and bullish resumption. Aussie dollar. So Aussie has been slowly showing signs of topping out over the past several days, topping out after putting in a 2017 and plus 2-year high above 80. There is still risk right now for additional declines, which could extend back towards the 77 area, but ultimately we do need to consider the fact that the breakout above 80 could suggest a medium-term bullish structural shift. So if we do see setbacks continue, they're expected now to be well supported in favor of a higher low. Dollar CAD. So dollar CAD has done a good job bouncing from its recent 2017 and plus 2-year low just ahead of 24. The market has entered a period of correction, which does suggest that it could extend a little bit more before it looks or considers the possibility of a lower top and bearish resumption. So right now the focus is on the potential for this corrective run to extend maybe back towards the 129 to 130 area before the market considers a more significant bearish resumption. Kiwi dollar. The New Zealand dollar has come under some intense pressure after recent rallying up to fresh 2-year highs, plus 2-year highs above 75. And just like Aussie, the break above 75 could be warning of a more significant medium-term structural shift that paints a picture for significant upside ahead all the way back towards 80. At the same time, with the market stalling out, there is the potential for short-term downside risk towards 72 before the market even considers that possibility. Right now, the market is pulled back quite a bit, so we're into some neutral territory, and we'll have to wait to see that next big break. Key levels to watch over the coming sessions are 74, 74.11, 74 74.16, 74.17 above. That's the high from the 7th of August. And then below, you want to pay attention to a recent low just ahead of 73. So let's call it 74.20 and 73 are the key levels to watch above and below over the coming sessions to see on Thursday if the market closes above or below one of those levels. SPX 500. The S&P 500 continues to show signs of being very well supported on dips despite some severely extended studies on the weekly and monthly charts which suggest that we could see a correction imminently. But again, the market has shrugged off those signs and has been unwilling to break down below any meaningful support, remaining supported on dips and still potentially at risk for breaking to another record high towards 2,500 and through that barrier. We would need to see a breakdown below 25.58. That's the low from the 27th of July to change this outlook. Gold. So gold had a nice bullish performance the other day with the market taking out a previous high that was in place around 12.75 and now confirming a higher low around 12.55, which sets the stage for a measured move extension coinciding with a retest of the 2017 high at 12.96. So the market could now be poised for a push beyond 12.96 in the days ahead and towards that retest that we've talked about of the 2016 peak at 13.75 further up. Right now, this 12.55 level, this low that we had seen this week, is now a higher low, and as long as the market holds above there, the pressure remains firmly on the top side. If we broke back below 12.55, it would only delay but not negate the broader constructive outlook for this market, and again, only below 1200 would compromise the constructive outlook for gold.